everyone. Good morning, good afternoon, good late morning. So yeah, as Alex said, it's such an important topic, and we do cover so much of the people that have gone on to raise their first term sheets and many more. But raising a term sheet is never easy, and right now it's probably about as hard as it gets. So I'm so happy to have these guys on stage with me to talk through how you do it. So James, maybe we'll start with you. I guess just early thoughts about how, at what point does a person who's got an idea start talking to potential investors? And, should they be talking to VCs, angel investors? How do you start that early network?
So I think it's a pretty varied landscape on that. Like when you're a first-time founder, depending on what networks you come from, your situation could be different, right? Some people are able to start with friends and family money. People in the demographic I invest in is like ultra atypical for that to be a thing. But you can go after VCs, and some people will take some of the cold outreach if it's cultivated in like a thoughtful way, meaningful way where there actually could be a connection. But getting to angel investors could be like an easier onset if you're not already in like a network of getting to VCs with warm introductions. But where you get your initial capital from, you just want to get from the best partners. So I mean, angel investors can be a good place if you're really early on, don't have a product, you want to find someone who really believes in you. But if you do have something that's working and you're trying to move something forward and you really feel like you could scale this to be something very large, it's okay to go to find a VC partner, for a pre-seed, someone like a precursor, things of that nature. So I think like it all depends on your situation, and I would say that it's all about finding people that you love to work with, and then we'll get to the term sheet part, but making sure that we're making the right partnership with the right terms.
Right.
Yeah.
Cultivating that relationship.
Yeah, I echo so much of what James said. How many of you are interested in raising capital but have not done it yet? Just raise your hand, proud. How many of you have already raised capital from venture capitalists? Okay, raise it high, raise it high. High. Everyone look around at who these people are. These are some of your sources of information on how it really works, and it's free. It's free, and they're generous, they're humble, because they've walked this path that you're all trying to walk. And I think it's so important that you understand that some of the best resources for this information are other founders who've already been through the battlefield. The question was around when or where.
I mean, both. Like how do just like the very beginning, you're trying to get coffee meetings. Like who are you trying to,
Yes, so success is planned, premeditated, and on purpose. Full stop. And if you want to be successful at fundraising, you have to understand it is a game. And in order to win this game, you have to understand the rules of the game, the culture, the unwritten rules that you won't read about in blog posts or see in podcasts. And so one of the things to get really clear on for yourself is, what are you building, and are you truly interested in making it VC backable? Because when you make it VC backable, you're signing up to go as big, as fast as possible. You need to be aligned with the investors and the agreement that these investors made with their LPs on the returns that they're going to have for the fund, right? There was an agreement that happened before you ever showed up to the pitch meeting. You need to understand that you need to align with that agreement. And so once you make that decision to opt into this game, really understanding which investors are for you and align to what you're building, the sector, the stage, the amount, even partners you want to work with. And I tell founders all the time, the websites that investors put up, believe them. There's something called an investment thesis on like every website. Go read their investment thesis. They are literally telling you what they made an agreement with their LPs that they're going to do with this capital that they're going to deploy. Once you've identified those people, make a lead sheet. If you think you have 10 investors on that lead sheet, I want you to make it 100. Right? Because this is a sales funnel, and it's about swings at bat in order to eventually convert to a home run, which is like a term sheet, which we'll talk about in a second. But the thing that a lot of people also don't recognize in the preparation process to securing a yes from an investor is an assist list. And so those founders in the room right now who raised their hand, they could be on your assist list. Oftentimes, you can build rapport with investors you don't have any relationship with by first building relationships with people around those investors. A lot of time people are so eager to get to the GP at the fund, but they don't really understand you have to work around those people first because they're going to be the intro that you need to establish your credibility to someone who doesn't know you. So I'll pause there and see.
Such excellent advice.
Yeah, I agree with both James and Mandela. It's the piece that is so interesting to me with working with early stage founders is getting in front of that network. One of the things so I started investing about 6 years ago, and the things that I've learned in this job is that it's still a very, very close network of people, right? So yes, the folks that you see in this room, they're great resources, right? Playing the game is a big thing, but the biggest thing that I've recognized is actually that confirmation bias that comes with investing, right? Going onto websites, seeing what people like. The best kind of partners you get to work with are the investors who are in the room with you on the table, and they already believe in what you are selling, right? For founders to walk in a room and to try to convince investors of a certain truth, that's going to be a really, really difficult task, right? So much of the game actually happens before during the meetings, right? It's all that preparation that you mentioned. It's all the reach out to the contacts, right? Writing really thoughtful emails out to investors, and then and really finding the right partner. You can actually find the right partners even before having those conversations, right?
You know, in terms of prepping for those early conversations, which are such a great point, there's just so much groundwork that has to happen just to, find those right people. What's your advice in terms of approaching a VC who already has a very similar portfolio company? Because obviously they're not going to invest in the same company, even if you're doing it better, that's a conflict of interest for them. So how do you sort of think about that? Or how should founders think about that? James?
I think things that are indirect competitors or kind of adjacent could be signals that they're interested in your space. Mm-hmm. If you're not actually going to cross paths with them, it's an opportunity. One, it's much easier to reach out to that founder and build a relationship because you have something to talk about. You guys could potentially have a sales channel partnership, things of that nature. But if that person is actually performing well for that fund, that person is a great intro to that investor. The founder that's making money for an investor is going to be the best intro to an investor. But then if it's someone who actually could be competitive, or most likely is, I personally typically shy away from it, from the sense that, especially if a partner is not reaching out and seeing a different angle, if it's like some associate reaching out, mm-hmm. they're just looking for information and trying to fill up time for their job.
Competitive analysis, right?
Yeah, it's just competitive analysis. So, I watch out for that. But there's always opportunities. When I do my investor list, I'm always looking at who's investing in market research, who's investing in market research around, particularly consumer insights and content consumption. And I'm going to find little products that are kind of in the realm, but they're not really pilotly at the time, right? So those are opportunities to find people that might actually be interested in cutting a check or leading around. Yeah.
I love this question. So I had my first experience entering this ecosystem was as a founder with no network in the ecosystem at all, trying to figure this thing out. And then later on in my career, I worked at a VC firm where I was faced with these questions of like, this looks like someone in our portfolio already. So what happens on the inside is that the VCs consult with the founders of the companies first who are in their portfolio, who may see this new opportunity as competitive mm-hmm. to align, because your allegiance is to the people you already made a bet on, right? And their reputations are hard earned and easily lost, even amongst your portfolio. And you're talking about how small the investor community is. The funded founder community is also very small, and everybody talks, right, about how investors treat you when you're doing well, when you're not doing well. So anyway, let me get back to the point I wanted to make when I heard your question, is that one of the things that a lot of founders don't recognize, and even I didn't recognize as a first-time founder, is that investors are never just analyzing you. They're analyzing you in relation to the founder that just left their office, in relation to the founder that's coming into their office after you, in relation to all the portfolio founders that they have, whether or not they're directly competitive or not. Mm-hmm. And so you really need to have this level of self-awareness and other awareness to really cut out a path for yourself on how you're going to differentiate yourself, not just as a company in the market, but as a leader and someone that they're going to believe in. Because at the earliest nascent stages, I don't care how beautiful your deck is. I don't care how wonderful and appealing the story is. They're making a bet on you. as the leader of this company and their belief in your ability to attract the talent and execute against what you just put in your 10-slide deck.
Right.
I think one tactical thing to add to that is on the competitive analysis piece, that's just part of the investor's job, right? And I do think there's some responsibility on the founder side to walk in knowing that investors do talk, right? The early stage scene especially, everyone knows each other. That's how we think about getting the best intel, right? We have our own fiduciary duties to our own LPs. And so, being upset at the mechanic where, an investor looks at you for half an hour and then invests in a competitor, that's not particularly productive. But recognize that is part of this journey, right? And share the information that you're comfortable sharing, but don't overshare your secret sauce.
Yeah, and have a time bound to it.
Yeah.
You know what I mean? Part of you start to get tipped off if they just keep asking for information without an exploding offer that you're putting on the table. Like, are you in or you out? You want to give all investors the benefit of the doubt, but there are some bad actors out there that maybe can linger the conversation on a little too long as they're trying to extract as much information as they can. At the same time, they're having the same conversation with the competitor that they're interested in investing in, and this is where the fear rises in founders. But
And that's a
you wanted to
great
say
point.
something.
I was just going to say the time bound is super important in general. When it comes to fundraising across the board, like if you find yourself fundraising for 6 to 8 months, you're not really fundraising. It's not a real process. So when you make it time bound, you take control over it, and people are stringing you along, you can tell them like, hey, I have other people I'm having conversations with. We're at this stage. What would it take to get you to this stage? What is the rest of your process? Like, be inquisitive of where they're supposed to be at based on what they say their process is. If they start deviating from that, then you can just leave that alone and keep moving on. But the other piece was when you're saying investors talk, like in that particular case, it could be a little bit to your disadvantage, but it is what it is. You leverage that to your advantage in doing what she was saying, where it's like not 10 investors on your list, 100 investors on your list, right? And when you try and pitch like 100 investors in 10 to 12 weeks time, they are going to talk. And if you tell them the right story, it's going to build this momentum that gets you to the point of said term sheet. So you can use it to your advantage.
Okay, these are all such great points. First of all, I also wanted to remind everybody to ask questions. In another 10 minutes or so, I'm going to be picking this thing up and answering your questions directly and posing them to these guys. You guys have touched on so many different and interesting points here. So in terms of, okay, let's get down to the term sheet piece. We're close. We have cultivated a bunch of relationships. We're in conversations. So ideally you're talking to, it sounds like, maybe 10 or 12 people if possible, just to get sort of interest going. And then, how long, is there any more specific advice in terms of how long you should be having these conversations? And I guess if it's not turning to something, what signal to take away from that?
I like to run a 10 to 12 week process tops.
Tops.
That's
okay.
one. That's you're basically talking
For a
about
full
one,
round.
for the
Not
full
one
thing.
investor,
From end to end. So me as an investor, I think some investors process can take 7 weeks. I personally like to, if I'm investing, I personally like to try and do it in 5 weeks. I want to respect people's time. I want to not get unfocused. I just want to decide if this is what we want to do or not do it. Other people's process could be different. Everybody will tell you their process. As a founder, I'm going to set out a timeline for how long I'm going to fundraise. I'm going to particularly choose how many meetings I want to have each week. And I'm going to set myself up as a funnel, like she said, sales process. How many introductions do I need to get to this many meetings? I'm going to go for those introductions and keep that cycle going and fill up those meetings. And in doing that, I'm also going to prioritize the people I want to speak with. So I have my high priority people who I feel like should definitely do the deal, and my low priority people who I don't think will do the deal. But I need to pitch them first, because if my story is a little off or I'm getting a lot of the same feedback, I don't understand the market or I don't understand this, I want to be able to pivot a little bit before I go to the people who I know should do the deal. And so by mixing up the low priority, a little bit of medium, a little bit of medium priority, a little bit high priority, and then really getting the thing rolling, you get yourself in a position where you've personally developed momentum to tell that story. Once you told this story 5, 10 times in a week, you just become snap, snap, snap. And then you're really ready to go hit the people you want to hit.
It's really about that momentum, right? With Techstars, we see a lot of companies, and we're looking at about, I'd say, a month to 2 months after demo day, where most companies raise their initial round. So part of it really depends on how big of a round you're raising, if it's seed, pre-seed. Series is a different beast, right? But it's really about having enough conversations so you can build that momentum. I think similar to what you mentioned, if you have 50 conversational investors, I'd say the first 10 or 20 years, that's practice, right? It's really being in a groove, being comfortable with pitching your company. The next 20, those are the ones that you really want to push on to be interested, right? To give you really good feedback and to really work those conversations. And then the final 20, those are usually the ones that, hopefully at that point you have a term sheet. Those are just the ones who come in to fill out the rest of the round.
Okay.
Yeah, and even if you looked at it like sports, right? I'm an athlete, play D1 soccer, right? So a lot of what I've learned in sports, I apply here. And I think about when I've trained founders on preparing for game day, right? Your pitch meeting is game day when you're really ready to launch this fundraising process. The season is starting. But like any good athletes, you don't just go into game one expecting you're going to win. You have exhibition games before, right? So what are you doing as a founder to simulate this experience where you can test out your pitch, whether it's on other VC-backed founders or maybe friendly investors, or maybe even an investor that is like, they invest in Series A. Maybe you're too early for them, but they're willing to take a meeting with you and you can at least test it out. But I really do believe strongly, not even believe, I know for a fact that the most successful founders in raising their round the way they want to raise it have had a clear plan. Because once you're in the thick of it and you're managing all these relationships and all these requests for due diligence and like it is hard. It's like a whole other job outside of just running your company and managing your team. So I really recommend measure twice, cut once. Like, take your time to prepare.
Great.
Yeah, I was going to say with that, when you think about like how you're actually going to like have that conversation, I've actually, now I'm not saying you should go do this, but I mean, now you're on Zoom, so you could do it. I mean, I've walked into offices and told somebody like, hey man, I'm going to point this camera towards me. It ain't for you, it's for me. I'll record myself having the whole conversation. I'll be like, damn, that looked really boring. Like, like my posture was off. My voice was super, had no intonation. It didn't look like I thought I was gonna make $1 billion. You know what I'm saying? Like recording yourself, hearing yourself, this is a script.
Right.
You know what I'm saying? Like people are like, I can't record myself, I sound like a robot. That means you didn't practice enough. If you practice it enough, it becomes second nature. If you want me to pitch Black Operator Ventures right now, I could hit the button and we'd be on the game. Like, this takes practice.
Right.
You know what I'm saying?
And it's a great point. And to your point earlier, Mandela, VCs are looking at this like, a mountain range basically. You're climbing this mountain, but it's one of many, as Jess Lee of Sequoia has said before, I think pretty eloquently. So, okay, now you've perfected your pitch, you've looked at yourself in the camera, you've got your script down, people are interested, you're getting term sheets. What are you looking for? I mean, what's got to be there, and,
Shoot,
and
I'll
how
tell
much?
you what, as a Black founder, I'm just looking for a term sheet first. So first,
Say that again?
right, just looking for the term sheet first. Okay,
Yeah.
so once you get the term sheet though, now the game's really begun because you were just trying to play the game, right? Like, I mean, that changes the whole dynamic of how you can kind of funnel in your process to get to where you want to go. But like, terms-wise, it just depends on where you're at. You do want to make sure that you're getting an agreement that is at parity with the level you're at with your company. You don't want to end up with an angel investor trying to give you some Series A preferred docs or anything of that nature. Like, if you are a pre-seed company, 90%, 99% of the time, you should be using a SAFE. And you can get it from Y Combinator's website. It's got all the standard language in it. No one can argue with it. Be like, go talk to Y Combinator about that. This is what we're going to do. When you look into that, you can find some details like most favored nation, which might be like, I want to make sure I have the best deal that you put out. There will be some pro rata in there potentially. You want to look at, do I have a 1x pro rata or is it more than that? If there's a higher pro rata, you want to make sure that this person is really in on what you are doing and actually has the capital to, is actually going to put that money in. That's what I like to look for.
James, can you slow down a minute? So when you say
Yeah.
if there's a higher pro rata, so this means that the investor can get a bigger bite of your next round, or get the safe?
Yeah. So like their allocation for the next round could be much larger. So like if you really like that person, and you know they got the money, it's something you can do. But if someone got like a 2x pro rata, but you're like, I don't really know if I want to work with this person forever, but they could put the money in.
Yeah.
You gotta look at that. Board seats, you look at that. If you're pre-seed or something and someone wants a board seat, it's a little bit of a wild ask, but I put it in a side letter and be like, this expires at this time, or if we find an independent who's going to be more productive or whatever it is.
So you're fine to join now. Maybe you can help me out, but
Right.
I don't want to be locked in with you for necessarily for the rest of my life, essentially.
Yeah, so those are some of the things to look at. Obviously valuation, and if it's a safe, is it a pre-money cap, is it a post-money cap? Pre-money being like, that's what it is but then all the money you raise, add to that, that's the valuation. So like, I typically am on a post-money safe if I'm doing something like that. It was very clear cut to know like what they're going to get out of it.
Does everybody agree that you should start with the safe for the pre-seed?
Yeah, pre-seed.
Largely, at least from the data I'm seeing, it's still largely safes or convertible notes. I think it's, as an instrument for founders, I think it makes a lot of sense, right? You don't have to have complicated conversations with equity pricing at that stage, and you can also layer on different safes for a little bit, right? So you can push out the conversation a bit. James, I am curious if you've seen more MFNs in some of these notes that you've seen.
I don't honestly think a lot of founders even know what that is. No. So I've presented it to people so they can know what it means, but it hasn't been something that has been a big talking point.
Got it.
Yeah, I think because the documents have been so standardized.
Sure.
The conversation just becomes limited, saves legal fees, saves time, gets the money wired faster.
Yeah, what I want to say about this point is, what do I want to say? Because there's so much. How many of you have ever hired employees or had people working under you, okay? And you found your person, right? You went through the process of posting and interviewing all these people, you found your person and they're winning you over, you're winning them over. And then you get to the negotiation of the salary and then you find like they're kind of poking at everything. Oh, what about this benefit? And what about this performance? And what about this? And what about this? And you kind of shift how you feel about them. You're like, oh, this is kind of annoying. Like I had all this momentum and good feelings. That's what happens with investors. And so one of the things to understand is do not wait until you get the term sheet to start going back and forth, right? The term sheet should be a reflection of what was already verbally agreed upon, right? In terms of the valuation, pre or post, right? All of the things that James was just talking about. It's really important that you understand that this is another human being and this is a power dynamic and this is FOMO, momentum, and you really want to be prepared all the way through. So don't wait until you get that legal agreement in your inbox to then be pushing back because it's really annoying to investors and it starts to adjust how they feel about you. And I've even seen the point where investors will pull the term sheet. Because your job is to, again, we all know we're not bulletproof, but you really want to be as bulletproof as possible in every stage of this, and it requires preparation and clear communication, and you're forming a long-term financial partnership here. And so don't wait until that shows up in your inbox to start really hard negotiation.
Yeah, I was going to say, with respect to that, you've planned out your whole fundraising process. At the same time, as you lean into that and start to see what the market is thinking, you also want to have a bottom line in terms of what you're willing to accept. And like at some point you may capitulate, but know your bottom line, right? And be convicted around it. And by being convicted around it and having reasoning as to why you're convicted, not just I want these terms just because, there's actual reasoning around the things that you're sticking to, then it actually, going back to what she was saying, positions you as a strong leader. They're trying to invest in leaders. So like they know there's gonna be a power dynamic here, but how you manage that and how you move things forward plays out on how they think you're actually gonna do other things like hire employees or get customers or any of that.
Guys, getting down to brass tacks, and I want to turn it over to the audience now. A great question is how much equity is typically distributed at each level of raising? Is pre-seed around 10%, seed around 5%, Series A 20%, et cetera?
What percent did you say for seed?
10%.
Okay. I mean, I think in today's market, that sounds kind of about right. I mean, valuations were out of control like 12 months ago, so it might have been like lesser ownership for some people, but
10% is really fair right now.
10% is pretty fair right now.
Yeah.
Yeah, and the 20% makes sense for the A. Yeah.
But no more than 20. Hold on. Hold on.
Hold on, yeah, exactly. We also mentioned multiple safes, Kevin, and I wonder, do founders run the risk of losing like sight of how much money they've, how much ownership they're sort of giving away in that scenario?
Well, I think it depends how wild the founders go, right? Typically the safes I've been seeing more recently, we're looking at kind of 7 to 10 cap, which has gone down from last year, right? Where everything was crazy. Think on that.
Let's see. What if you have a safe and then go into a low next round from an accelerator like Techstars? Will they adjust their investment to meet your safe?
We do not. And actually across the board, I think it's mostly standard terms these days for when I look at YC, when I look at 500, it's mostly standard terms. Yeah.
There's some different opportunities there though too, right? Because I believe like Techstars, like they have the program component and then they have the access to money component, right? So say you already raised money, but you really want to be in Techstars, you don't have to take the 100 grand or whatever it is.
Sure.
For the,
Yeah.
for the
Yeah.
percent.
But so on the I guess piece about being flexible, we have flexibility on the 100K convertible note. If you've raised a little bit more money, it can go a little bit higher. But
Okay.
it's still pretty standard. I guess like the one thing to plug here is, if you've raised money and it's at higher terms than what we would offer, part of why some founders still come is because of all the value add pieces that Techstars provides, right? We have a lot of programs. We have a big program with JP Morgan. We have big programs with different healthcare systems. And for later stage founders, getting that access, they think the math works out for them.
One question I meant to ask, and I'm glad somebody did, what is a red flag to look for in a term sheet that should absolutely not, founder should not?
I mean, if I see like exclusivity, if there was a thing around that, non-founder friendly anti-dilution clauses,
Liquidation preference.
liquidation preference.
Are you seeing those? Are those coming up already now with this changed market?
I think people, again, like the documents have got so standardized to a certain degree, like only bad actors are trying to put stuff out there like that. So those are like signals that someone's not really looking to be having your best interest in mind.
Right, for the longer term.
So
Yeah, the
like,
whole point of the SAFE agreement, it's a simple agreement.
Right, that's the whole
future
point.
equity.
Yeah.
The whole point
It's
is
simple.
to simplify
Yeah.
this negotiation, this power struggle for ownership in the company
Yeah.
between the founder and this investor at these early stages when really your deck is an idea, right? For the
Right.
most, like we all know what this is. Like there's certain degrees of traction, right, at this stage, but let's just cut through the noise. We norm at this point, and no, I don't think there's been too much adjustment at the early stages, like pre-seed and seed.
Not
I
yet,
think those
yeah.
are later stages, like even when we talk about liquidation preferences. But most of the investors that I work with and know of that are investing at the pre-seed and seed stage are using SAFE.
yeah.
So because of safes, there's really no terms that they should avoid.
Well, I mean, anybody can do anything, but truthfully. But I would say like, say, we'll get into the preferred equity component of this, but like, I think another thing to think about is someone's ability to like veto a future round of funding. Like sometimes people want to make sure they're not getting down rounds or not being diluted in a certain way. So that's something else to look out for. Like, is anybody trying to position themselves to have the veto power over what the next round of financing is, or what the structure of it should be?
Right.
So
One point on that, so especially for founders who are international, if they take money from investors who are not based here, who are not used to market terms here, sometimes there'll be terms that will be prohibitive for you as you think on follow-on round, right? And so that's something to be aware of, especially if you are a company that's looking to flip to the US at the Series A or Series B, right? Recognizing that if your existing investor has clauses in that are more kind of protectionist, right, trying to keep the company in the country or in the region, that's something that you might want to consult a lawyer early on.
Interesting.
Yeah, there was something I wanted to say and it just escaped me, but it was around this concept you alluded to earlier about like if you're a black founder, it's just great to have a term sheet 'cause
Right.
it's so rare. Same with women, right? And women of color in particular, black women. What I wanted to say is that and this is why it's so important to understand the rules of this game before you decide to play it and start playing it, because you can be taken advantage of, right? And what you may not realize because you're in these agreements, you're just like, okay, yes, someone said yes to me, I'm going to take this, is the consequences of that decision when you go out to raise your next round, because those more sophisticated institutional investors are looking at these like WTF. Like, I'm not touching this, right? Because you've already made miscalculated decisions, and without recognizing how it's impacting your ability to bring in more established or even larger rounds of capital. And so what people are assessing you for is, are you a good steward of capital, right? And so I think this is like a real switch you have to do from being an inventor of a product to, are you a CEO of a company who can manage investor relationships and be a good steward of capital? And that's what they're assessing for as well.
That's also an excellent point. How do you approach conflicting opinions? This is a great question from investors on valuation and terms.
I was going to say,
Oh, sorry,
actually
go ahead.
tacking on, because we were talking about worrying about what the investor is doing. Again, going back to what she's saying, worry about what you're doing to yourself too. Like when you think about the valuations of things, like if you have a substantial reasoning around how you're positioning your valuation, I feel like it's hard for an investor to argue at most times. That investor might be arguing for a certain amount of target, like ownership of the company that they have for their own personal portfolio construction, but like, you know, if you have real reasoning around said valuation, you shouldn't be having too much debate really right there, because this, again, it's such early stage. If you guys are both super excited about what's going to happen and there's some sort of like grounding around that, like it should be fine. At the earliest stages, you know, it's an idea. It doesn't really exist. It doesn't make money. I mean, let's just be realistic. You can go and lie and be like it's a $40 million valuation, but truthfully, like most pre-seed rounds in reality should be somewhere between the range of like, I mean, at the lowest for me, like a $3 million valuation, maybe at the highest, 10. It doesn't exist. So let's put it somewhere in the range based on your background, the possibility that's going to have some sort of success, and like let's all be reasonable. Once you start escaping that realm, you start going into like random, you know, a false reality, right? But I think as a founder, one thing to keep in mind is like the higher the valuation, not the better. Like building a company is actually hard. So I've actually sat down with companies who was raised at a certain valuation. It's a pre-seed. They ain't really making no money. They want a $10 million valuation. They want $750K. You can maybe not build that much with $750K. And the thing is, you're going to have to go raise more money. And when you go do it, if you didn't hit a certain milestone, create a certain level of momentum, you know, you will not be able to raise another round or extension above that valuation. Now you've killed your whole momentum.
Right.
You start to kind of, you know, degrade your ability to raise capital.
It's storytelling. It's storytelling. Your pitch deck is a children's book, right? It's a bunch of photos, a little bit of words, small amount of pages. It's a story, right? And so whatever story you tell, and you add a number to that in terms of how much capital you're bringing in, at what valuation, at what cost, right, is to the milestone point that you were talking about. They're going to go look back at that story and say, did this come true? Did this fairy tale come true? And then from when you're getting ready to raise your next round, they're going to ask you, how did that last story go? Because you're selling me this new story. So you have to be wise about what you are telling. And of course, it's not all going to work out. It actually will not all work out, right?
Right.
You're gonna,
it never will.
You're building off a set of assumptions and some data, right? And so everyone knows on both sides of the table, right? We're doing the best we can to figure this out as we go. And the next story will be iterated accordingly. But you don't want to have too much divergence, because that's when they start to look at you differently and you become less of a reliable source of leadership and information for this market.
Yeah. This is random reiteration. It will not go the way you planned. You know what I mean? It didn't go,
Everybody knows that.
It didn't go that way for Elon or Steve Jobs either. You might like them. It didn't go their way either. They should not go the way they planned. I promise you. So
There's something to be said about how much leverage founders do have, though, right? You go through the process with investors. A lot of the funds you talk to, they're doing maybe 5 to 10 deals a year, right? By the time they put a term sheet in front of you, they're here to do business, right? They want to work with you.
Can you say that again? Because I don't think people realize how many
founders have a lot of leverage, and most investors make very few investments, right? So if they are in front of you with a term sheet, you should negotiate. It's
like getting a job, right? You know, we go to jobs, we didn't know any better. We go to jobs, they're going to pay us. Like, that sounds great. We'll take that money. Wrong, because if you offer me a job, you didn't offer me the most money you can pay me for said job. So let's start talking about what else can we get out of this conversation that's going to make me happy and get you what you want, because you want to be with me, right?
James, to that point, you mentioned earlier that Black founders tend to take term sheets right away because they're like newer to the industry. They have less experience. They may underestimate their leverage. They may be facing bias. So I think this is truer of them, but this is true of every founder. You get that term sheet. What do you do with it? Like, how do you then drum up more interest? How do you establish more leverage for yourself? Like, how do you talk to other investors without burning that first investor?
If you're lucky enough to have, I'm not lucky enough, if you were smart enough to have set up your process and you're lucky enough to have that term sheet come earlier in your process, it just helps you to create an anchor and a driver to push people down into the funnel you're created. So like, the best case scenario is You've been talking to founders, you've been meeting some VCs, you've been telling them like, hey, I'm not raising yet, I might be raising in the next quarter, but would love to be able to keep in touch. The best thing is like you meet some people along that journey and someone says, I'm really interested in this, like I think we could do a deal like X, Y, Z. And that kind of preempts your process. So now you can begin your process knowing that there's someone else in your corner. That's not gonna happen most of the time. So then once you get into your process, you've made some relationships, you've gone through two or three meetings, because remember, you're always trying to get to the next meeting, right? So once you've gone through those, you actually get that term sheet in. Now, you give a little bit of breathing room. You want to respect people's process. But if you're into the depths of someone's process that you think is really interested, it's time to follow up. And as you go through your process, another thing you want is like different updates on progress you're making, right? New things to reach out to them with. So when you reach out, you say, hey, we had this progress with the company, and it looks like we already have some interest. So now, next week we're going to be looking to see. Are you actually going to be interested in investing? We'd like to get together partners that actually want to be a part of the round, and we already have. We already have a term sheet in place, but we're really interested in working with you, so we'd love to see what you have to offer. But like now you have something to say, hey, come see me if you're really interested. This person wants to be here, but I'm also very interested in you, so I'd love to see what you have to provide.
Right.
It's very much using it as leverage for a forcing function, right? And this is why the momentum that you described earlier matters, right? You have 20, 30 conversations, one person comes in with a term sheet, everyone else is still waiting in line and kind of taking their time. You go back to them with a term sheet, you accelerate the timeline.
Right.
That is the key there.
And I guess at one point this is an audience, an attendee question, at what point should you walk away from an investor if you cannot agree on terms? I guess maybe at what point do you know that you can't agree on terms? Like there's just...
You mentioned before, right?
If you don't want to lose that investor too.
I mean, you know your floor, right? Like, and I think, again, like if you're articulating your bottom line, just very clearly, and there's reasoning around it, and someone won't meet you there, and you're a pre-seed stage company, it's probably not the person you want to work with. So like, you just have to kind of take that L. You gotta be like, man, I do really want to have this money, but like, you don't really want to be trapped with someone who doesn't really want to see you successful, because again, building a $1 billion company, like, yeah, you can have the smartest people building a company. It doesn't happen just by one person. It's like people around you really helping you do it. If you get in business with someone who doesn't even want you to win right now, like it doesn't have any sense to think that that person is going to help you win in the future.
Yeah, I think the preparation, I'm kind of answering the question, but kind of not, but I think I want to say this. I know I want to say this is the preparation piece that I keep going back to. If you're raising $1 million, right, there's many ways you can raise $1 million. You can say, I'm going to go after just angels, right? And I'm going to get 100 angels to invest $10K in my company, right? And the reason I'm going to focus on angels is because it's their money. They can do whatever they want with their money. Right? Whereas you can say, never mind, I'm going to have 2 investors and I'm going to go after 2 $500K checks, or I'm going to have 4 investors go after 4 $250,000 checks, whatever it is, but you need to have a plan, because there are trade-offs and there are consequences depending on who you're going after and who you're partnering with. It's just really important. There's something else I wanted to say, but it left me, so continue.
Another question, can you renegotiate an initial term sheet after getting more follow-on funding and momentum? In other words, fight a most favored nation.
I mean, you can never renegotiate the actual initial one, but surely I've come in situations where the people who invested before me do not have the same terms I have. Now, we might go back to them just because we want to all be cool and be like, yo, it's actually this now, because this is what makes sense for the company. It's beneficial to us. It is a lower valuation, but it's actually beneficial to the company based on what their milestones are going to be, how much money they need, their ability to raise future rounds. But again, if there's reasoning and sound reasoning around it, there's always room for change with people who want to see someone successful. So the opportunity is there. It's not popular, I don't think. I think most people just see the deal and it's like, well, I wanted the deal, I'll follow what's there. But if you think it through,
Yeah, and I know we're talking about capital, but there's so much that you get from investors beyond capital, right?
Right.
And like this should be a part of your plan. Like, I would take a smaller check from somebody who maybe has domain expertise or has this other massive network that I could unlock and get into, right? So don't always just size people up based off of how much money. Factor in their brand, their network, their domain expertise, all the other things that you can leverage.
Absolutely. I was going to say the next question, and I would say yes, is it okay to be flexible on certain terms for a high value investor? And it sounds like you're saying, 100%.
Definitely. We're in the midst of that right now. Someone's going to give up a decent percentage of their company, but for the opportunity to build something that they could never build without the support of these people who have repeatedly made billion-dollar companies in this space.
Right.
They want to work with this person.
Yeah.
And so it's like, this is how our portfolio is constructed. Typically, we won't be working with you at this stage, but we like what you're doing. You like us. You're like, okay, let's get it done. Now, it's going to be a hit it's going to be hit, but that's going to change the whole trajectory, because owning 70% of something that's worth $50 million is very different than owning 20% of something that's worth $1 billion.
Right, absolutely. Guys, we're out of time, but thank you so much for joining us. I hope this was instructive for the audience. I learned a lot.